for free information on stocks, options, futures, indexes. Get to know iknow.com.
Good morning. My name is Bill Williams, and I'm going to be assisted today by my daughter, Justine. And as we were saying the other day, there's not a lot we can brag about as being speakers, but one thing we do have terminal facilities, which means we quit on time. And today, particularly, we're going to have to sort of quit on time because we have a mad dash to the airport. So what I'd like to do is to invite you to ask any questions that you have. And don't be afraid to ask questions, because you may think it's a dumb, stupid question, but most of the time there are a bunch of other people in the room who have that same question who are probably thinking they're dumb and stupid if they ask it. So anytime, this is not a speech, this is a presentation. So anytime you have any questions, well, just raise your hand or holler or whatever. What our goal is today is to share with you some of the things that we have learned, that I have learned in over 40 years of trading. I'm now in my fifth decade of trading. And Justine, my daughter, who will be here shortly, she has been trading. She's a good trader. She's a great teacher. And we do a number of things. Number one is our primary occupation is trading our own funds. In addition to that, we also find it very beneficial to us to assist other people in being successful. And that's not an altruistic thing, because we learn. You know the old saying that if you teach, you learn twice. And we learn from teaching. So this morning, our goal is to share with you what we feel is a sort of unique way of looking at the market. Most of my trading in the market, most of the years in the market, have not been profitable. The old technical analysis has not worked for me. And one of our main feelings is that the market is not economic, it's not fundamental, it's not technical, and it's certainly not mechanical. There's a guy in Saudi Arabia, if you have a mechanical system, that you will guarantee him to work for only 6 months. That's all you got to do. If he buys a system that will work for 6 months, he has a standing offer of $36 million he will pay you. All you have to do is guarantee it to work. If a mechanical system worked, you and I, if we could get a hold of that mechanical system, in about 6 months, we could probably buy Paraguay or Uruguay or maybe both of them. The market is designed so that mechanical systems don't work. If they did, there would be no market. And hopefully before this session is over, you will have at least an understanding of our insights into the market. So be very, very clear that you can ask questions anytime. And this chart here, we'll get back to this chart. This is a chart of coffee of 2 months of trading in April and May, and had you taken every signal, one contract of every signal, it would have been a $500,000 profit. And that could have been done with a $40,000 account without ever margining more than the account. So let's start with the presentation. From past experience, and we've been doing this for many, many years now, working with traders, and we know something about you. Even though we may not know your name yet, but we know a couple of things about you. Number one is we know that people who are attracted to trading are in the top 10% intelligence-wise of the entire population. So this group, if we're representative of traders, we could probably challenge the Mensa people on the $1 million giveaway. And maybe we could have $1 million without asking somebody else or asking the audience if you're following that program. So number one, we know that you're smart, and we respect you for that. The second thing we know about you is that you've been previously successful. You've been a success in either a profession and or a business. There are very, very few, extremely few. I only know of 3 people in thousands and thousands of traders that we've worked with who came out of high school with the intention of, I want to trade markets for a living. It just doesn't happen. It happens after people have been trading after people have been making money for a while. For example, the biggest group of people who attend our tutorials are medical doctors. And they come in 2 classes. One of them is they're trying to get out of this litigious society, and the second is that they're so fed up with dealing with HMOs and this sort of thing. The second 2 biggest groups who come to us are engineers and lawyers, somewhat similar reasons. So we know 2 things. We know that you're very smart, we know that you've been previously successful, and we also know another very disturbing fact, that 90% of people who come into trading commodities lose money. So if we can somehow figure out this problem, of why the smartest people in the world who've already been successful come to trading and they aren't successful. If we can figure that out, then maybe we have an up on the market. And as we said, we believe that the market is not economic, mechanical, fundamental, or technical. We believe that the market is psychological, that the market is basically a composite of all of us crazy traders making these crazy decisions out there. So if the market is psychological, then what we want to do is we want to get in touch with the market. And if you've been around many of the speakers in this group, and I hope you have, you'll hear over and over, and you'll read in the books, there is no Holy Grail. Well, let me stand up here before you and tell you there absolutely is a Holy Grail. And I will share that Holy Grail with you, and you can remember it the rest of your life. It's only 5 words, 5 simple words is the Holy Grail. Those words are want what the market wants. Now, what we normally do is we want the market to do what we want, right? But we want, if we're going to trade the market, the only way that we personally have found to be successful in trading the market is to want what the market wants. That means that what we want doesn't matter. What we do every day, every minute that we look at the screen, we ask ourselves one question about the market. We ask ourselves, do we care which way the market goes? And if we care, we're in trouble. Because if I came over here and I hit John and I slapped John on the face, he would get right up and he'd slap me down because he's bigger than I am. But I would be in control of him because he would be reacting to me, right? Even though I would be getting beat up, I would be in control because he's reacting. Most of us traders, we react, don't we? We come to the market, we have expectations. I bought the bonds because I thought, hoped, wished, and prayed that the bonds were going to go up. And if the bonds don't go up, then what happens? I'm discouraged, the market is crap, and nobody can win at this, and they've lied to me, and it doesn't matter who it is, and it's all a scheme to get my money. If you don't have any expectations, you can't be disappointed, can you? And if you don't have any expectations, you can trade in such a way that you don't care which way the market goes. Now, to do that, what you obviously have to do is you have to get in tune with the market. You have to get your psychological perspective in tune with the market. So what I ask you to do with me this morning is to go with me and bear with me for a few minutes while we talk about the psychological aspects, and then we're going to tell you how we tune into the market and let the market tell us which way to go, and how we can trade without having any expectations and any disappointments. And I would tell you that it's probably been, now I think it's probably been at least a dozen years since I've been ticked off at the market. I don't get angry at the market because I have no expectations of the market. Let's look at the current situation. You're here probably because you can't make consistent profits, because you've been an overall losing trader, and talking to a number of you out in the hall and in the reception area, that seems to be the consistent thing, that I really think there's a fortune to be made here. I just haven't figured out how it is yet. And you're losing, maybe possibly you're losing too much too consistently. You've tried all the approaches. They seem to work for other people. They work for the guy who's selling the approach, but when I get in there, it tanks. Have any of you ever had that kind of feeling or that kind of experience? All of this is a bunch of bull because it doesn't work for me. Well, we're going to look at that this morning. And let me say one statement, and this is with all love and care and friendship, and what we're trying to do is look at the facts. If what you have been looking for could have been found in the places you've been looking, you wouldn't be here today, would you? So something hasn't worked, or you wouldn't be here. Now, my goal is that by the time we leave here in a couple of hours, that the market will be a much friendlier place. You'll like the market better, you'll go home, and you'll do better than you've ever done before. So let's see if we can do that. The next step, what we're going to look at today is, first of all, how the market really functions. And one of the reasons that 90% of most traders lose money consistently is that they don't understand what the market is. They think the market is something that it really isn't. The market is a very, very simple thing. A guy by the name of Richard Dennis, who some of you know and most of you have read about, who is kind of the 20th century example of what can be done. And according to the legend, Richard borrowed $1,200 from his aunt, started trading on the mid-am, and in a period of about 10 to 12 years, parlayed that to somewhere between, as legend goes, $200 and $400 million. I was in an audience once where he was asked, this was not an audience, it was actually a dinner, and there were about 25 people there, and he was asked, Richard, you have made more money than all of us maybe put together, and what's the secret of your success? And he came out with something that impressed me. I wrote it down, I put it on the mirrors, and he said, the reason I'm successful is that I learned early on that there's a lot less here than meets the eye. Now think about that for a moment. It's the best description I've ever heard in my life. There's a lot less here than meets the eye. Let's take an example. How many of you have ever remember seeing the Flintstones on television? Oh, good. All right. You know who I'm talking about then. It had two main male characters. Remember, there was Fred, and the other guy's name was Barney. Right. And Fred was kind of the enthusiastic, egotistic, outgoing guy who's going to go out and kill dinosaurs with a handheld club. And Barney is more of a college research professor kind of guy. He thinks about things before he does them, and he really doesn't enjoy going out and getting all dirty and sleeping on the rocks and this kind of thing looking for those dinosaurs. So Fred goes out one day, has a good day hunting, and he grabs himself a big dinosaur, and he drags that mother home by the tail, and he's cutting him up, and he looks across the fence, and he notices that his dinosaur club is kind of worn out a little bit because he's been using it a lot, and he doesn't like to hang around the house and make these things. Barney likes to make them. So he looks over to the fence, and in Barney's workshop there, he's carving out one of these clubs, dinosaur clubs, and Fred thinks to himself, man, I would love to have that club. How could I get that club from Barney so I wouldn't have to make me one? So he walks over to the fence and says, Barney, I got a deal for you. I'll trade you 2 platters of dinosaur whoppers for that club over there. And Barney thinks a minute, and he says, okay, Fred, you got a deal. Now, they have just created a market. And there's no market in the entire world that's more complicated than that. Every market in the world, no matter what you're talking about, whether you're talking about Forex, the Board of Trade, the New York Stock Exchange, the Board of Options, doesn't matter. Every market in the world is designed on that principle. And the markets are simply designed specifically to find that exact price where there's an unequal value estimate and a disagreement on value and an agreement on price. That's all in the world any market is. It's a place where it's designed to find that exact price immediately where there's a disagreement on value and an agreement on price. Think about the last time you sold a car or bought a car. You bought a car and you wanted that car so bad, Peter, that you paid for that Jag. Now, the guy who sold you that Jag wanted your money more than he wanted the car, right? So you made a deal. And that's a commodity market. And that's all in the world it is. Now, if that's true, and we happen to think it's true, and we're going to get to this one in just a moment, then we can eliminate a lot of things. One of the first things we can eliminate is bullish and bearish consensus. Because there is no such thing. Now, think about that for a moment. What happens when somebody comes out with a bullish and bearish consensus report? All they do is they go around the room, or they have a certain population, they say, what do you think about gold? You like it. You like gold, you like gold, you don't like gold. Okay, we've got 75% bullishness in gold. Now, what does that mean? All that means is he hadn't surveyed all the bears yet. Because there can't be 50.000.1% bullishness in gold. If there were, gold would have already gone up. Because remember, the purpose of the market is to find that exact spot where there's a disagreement on value and an agreement on price. And it's not any more complicated than that. So anytime you read bullish and bearish consensus, it doesn't mean anything. If somebody says, well, gee, you know, the gold's really bearish, you know, that doesn't mean anything. That's an opinion. Another thing we can throw out and simplify our life and make the market a lot less here than we thought it was, we can throw out oversold, overbought. Now, we had one guy at a tutorial that it sort of took us about 30 minutes because he said, you're crazy, you know. There has to be something called oversold or overbought because they got indicators for it. I got it on my computer. You know, I can read it right off the computer. It says oversold. Well, all that means is it went lower than the person thought it was going to go. Doesn't mean it's oversold because the markets are designed specifically so that it will never, ever be oversold or overbought, not even for 1 second. So we can eliminate bullish and bearish consensus. We can eliminate oversold, overbought, and that's going to help us out a great deal because that's going to make the market a lot simpler. Something else that we can absolutely throw out is a lot of money management techniques. Now, if you read many money management books, you will read over and over again that, well, if you're going to call the broker and you're going to buy the bonds, let's be wise about this thing. So when you call the broker on the same phone call, don't hang up now. You put in the order, I want to buy the bonds at a certain price, and, broker, be sure that you put me a stop $500 away. Because good money management is never to lose more than $500 on a bond trade. Have you ever heard anything like that in your life? Okay? Well, from one standpoint, that's pure stupidity, isn't it? because you're not trading the market, you're trading your wallet and you're trading the bank account. And believe me, if I've learned anything in 40 plus years of trading, the market has no concern whatsoever about my bank account or my account. It doesn't care whether I make $1 million tomorrow. It doesn't care whether I lose $1 million tomorrow. The market has no investment in me. I have an investment in the market. Any questions so far? Okay, do me a favor. Do yourself a favor. On one of the sheets in the notes, it asks you what animal is the market to you. Now, what we have on the screen is a donkey and a shark. But ask yourself, what animal personifies the market? I'm from Mars. And I just came down, and I've spent some time on a dairy farm, and some guys took me out in the woods, and I know about bears and this sort of thing. So I understand the animals in the world. What I don't understand is the market. So I come to you and I say, what is the market like? And you know that I know about animals, so you're going to describe an animal that most personifies the market. So would you do that?
Write down the reason? Or
No, not the reason, just what is that animal? Well, what is your animal, sir?
Well, the whale. It's big and tremendous and powerful.
Big and tremendous and powerful, yes. Somebody else, what did you have?
Donkey.
John?
Donkey.
A donkey. What does the donkey personify to you?
You can't get it to go the way you want it to.
Oh, okay, it's a donkey. It won't go the way you want it to go to. Jan? A shark. Okay, what is a shark to you? Yeah, you leave any little finger or digit out there, it's going to come for it, right? Or if you make too much noise, it's going to come after you too. Okay, somebody else that has a different animal. Anybody? Yes. Hummingbird. That's interesting. I've never heard that one. Tell me about a hummingbird. Yeah. Okay. Zip, 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 and it's hard to catch and grab. And okay. Somebody else with something different. That's great. Yes, sir. Peter. A snake. Okay. What does a snake personify to you, Peter?
Lays in the sun on a rock.
Uh-huh.
When it's hungry.
Uh-huh. And sometimes it'll look very docile, and you'll not even know it's there, and it grabs you and bites you. You think you're okay, and then you're headed for the hospital, financial hospital. Yes. Yes.
A squirrel that goes up and down the tree, and it tries to hoard stuff, and sometimes it forgets where it puts it.
Ah, yeah, right, good. It's a squirrel. It goes up and down the tree and hoards stuff and puts it away and sometimes forgets where it puts it. Yes. Yeah, right, I've been there. Yeah. Okay, anybody else have a different one? All right, what we're going to do then, hopefully in the next few minutes, the market will become a much friendlier place. And I'm sure it will for at least some of you. So let's go on here. What the market really does, it finds the exact place. We can eliminate all of that. And let's go to what we think is, at least from our standpoint, a little bit of our uniqueness in trading the markets. In undergraduate, my major was engineering physics. In graduate school, my major was psychology. And believe it or not, those two things go hand in glove. The 20th century, I think, is going to be remembered by three big things scientifically. The first one is relativity, then quantum mechanics, and the science of chaos. Now, what happened in classical science, the last 2,500 years, in classical science, we've been building up, and we've been climbing this ladder of wisdom, only to find out it was leaning against the wrong building, that all the things that we thought were true are not true. Remember, it was consensus classical science that thought the earth was flat. I mean, this is a self-evident, obvious fact. You can climb up to the 19th floor here, and you can look out there, and the earth is relatively flat. We know that is not so now. In geometry, those of you who took geometry in high school remember that there was an axiom, and an axiom is a self-evident truth, supposedly, that the interior angles of any triangle equal what? 180, a straight line, doesn't it? 180 degrees. Did you know that happens to be true only in the gravitational field of the earth? If you get a third of the way to the moon and add up the interior angles of any triangle, it adds up to be more than 180 degrees, because it only happens to be true in a certain specific area. Most of the things we learn about trading turn out to be only true in certain specific areas. And you can take an instrument like TradeStation, and I guarantee you and I can go down and power that thing up, and we can create a winning system about 1 a minute. And all we have to do is curve fit and optimize and push the buttons, and out comes these things. But the better it looks in the past, guess what? The more guarantee it's not going to work in the future. Because one of the false assumptions that all technical analysis is based upon is that the future is going to be like the past. And if there's anything that we have learned in the last century, I think, is that the future is not going to be like the past. So what happens is these very smart people, you, come to the market, and you don't succeed, and then you get worried about this, and the first thing you do is you go look for old charts, don't you? And you say, gee, if I'd sold gold 20 years ago, if I'd gone short gold at $800, look how much money I would have. So then you go looking for something that looks like gold looked in 1980, and you try to replicate that. The only problem is it doesn't work. But that's what technical analysis is based on. If the market is psychological and not technical, then we need a new tool. And that new tool, for us at least, that has proven very successful, is the science of chaos. Now, don't let that word throw you. Chaos simply means new information. And this is the most important thing that I will say in this whole 2 hours. The thing that I would like for you to think about more than anything else, and the thing that will do you more good than anything else, is thinking about how do you handle incoming new information. And there's only two ways. Now, the way you've been taught, the way I've been taught, the way everybody's taught from pre-kindergarten up through postgraduate school, is that you take in this new information and you fit it into old categories. So if I tell you something new, if I show you a new oscillator or something, probably your first thought is, well, that kind of looks like the RSI, or maybe that's the stochastic, isn't it? Or you're taking the new information, you're massaging it and distorting it so it fits into old categories. Now, the reason we do that is simply because we like to do that, because it gives us a feeling of control. It gives us a feeling of predictability. It doesn't give us the truth, though. Let me give you a couple of examples. I woke up this morning, and there was a lady lying right next to me in the bed, my wife. Now, my assumption was that was the same lady I went to bed with last night. But you know what? It wasn't. But it's very convenient, isn't it? I mean, if I meet you and I get to know you and I get to know your personality and I see you in a year and you've changed greatly, what will I say? Well, Peter, what happened, man? I mean, you're not the old Peter I knew, kind of thing. We have these expectations from the past, and then we trade from the past, as opposed to trading from what's happening now. Remember the comedian Flip Wilson, and he had the church of what's happening now? Well, we want to trade the market of what's happening now. We don't care what the market did. We want to know what the market is telling us right now. So we're not into form-fitting. We're not into templates. We're into behavioral kind of trading. And everything that you do, that you're taught, is to fit new information into old categories. The only other way to treat new information is to let the new information organize itself. And that's kind of scary, isn't it? Because that produces risk. And the reason we want predictability, the reason we want control, the reason we want to know beforehand, if I'm going to buy gold today, I want you to assure me that gold's going to go up tomorrow. We want that because we want that control, and all of that is a cover-up for one thing, which is fear, right? Now, I don't know if you've ever, you probably haven't done this, but I've had many times when I have put on a trade and I could feel my body going into a fetal position. You know, the market's going to beat me up really good, and I can feel it body-wise. Well, if you're doing that, you obviously are fitting new information into old categories. And talking about risk, we were talking outside with Larry Williams a while ago, and one of the things that my wife and Melody Baker, who has the CQG, they were in a cab yesterday, and the cab driver asked them what they were doing in Las Vegas, and they said, well, we're here for a meeting. They didn't tell them what kind of a meeting, but we're here for a meeting. And the cab started preaching about he had bought a course from this guy, and he had lost $20,000 of borrowed money. And, of course, they didn't tell at all what kind of meeting they were in, because futures, trading commodities, stocks, and futures, sometimes has sort of a negative connotation. I don't know if you've noticed this or not. But you tell somebody, what do you do? Well, I trade commodities. You gamble? You mean, how much money have you lost? This sort of thing. Trading has a good, substantial, valid economic base. What we really are is we're in the insurance business. We're taking risks that other people don't want to take, and they will pay us enormously well to take those risks. And if we can take those risks judicially and we know what we're doing, we can get paid enormously. So don't think of yourself as a gambler or it's a zero-sum game. We're performing a valid service. We will take risk over time, over product, and over space. And if we do that well, I guarantee you'll have the best paying job you could possibly have in the whole world. Okay, so we have two choices. And let me give you and this is the most important thing I'm going to say in this whole thing to me, is what do you do with new information? And if you put it in old categories, and I respond this morning to Ellen the way that I went to bed with Ellen last night, the way I was feeling about her last night, I'm doing an injustice to both of us. Because she has changed, and I have changed over the last 8 hours. And you will change while you're in here. So let's go to the next most important slide, and that's this one. Let me give you the simplest organization I can think of. Now, the simplest organization I can think of in the entire world is a hydrogen atom. Hydrogen atom has an electron and it has a proton, and that's all it is. And there are trillions and trillions of those floating around this room right now. And they're just doing what hydrogen atoms do. They just take the path of least resistance. Now, one of the three principles of chaos, and let me state those three principles, and then we'll get to this. In the science of chaos, there are three principles. The first assumption is that everything in the world is energy. In fact, Einstein said there are only two states. There's nothingness and there's condensed nothingness, which we call form. Now, in classical physics, where we thought for every action there's an equal and opposite reaction, and I used to teach that in engineering school. I taught the laws of motion and this sort of thing, only to find out today that I was lying. No, those laws aren't really universally true. So everything in the universe is energy. In chaos, there are three fundamental principles. Number one, everything is energy, and energy always, always follows the path of least resistance. Now, you're in here for whatever reason that this proved to be for you the path of least resistance at this time. And I'm glad it did. I really am. Let me give you an example. Let's say that right now you had the urge, you had to get up and you had to go to the bathroom. Well, what you'd probably do is you'd go out that door, go down the hall, turn right, and then turn left if you were a man, and go in the bathroom there. Now, the bathroom's right straight through there. So if you're into efficiency and you want to get to the bathroom fast, it's right there. Why don't you go there? Well, you've learned in the past because there's a wall there, yeah, and it's not really good for your nose and your health to go through the wall. So you do this behavior, but the underlying behavior, the underlying structure of that behavior was determined years ago by an architect, by a contractor who built this, who put the doors and the walls there, right? So the second principle of chaos is that this path of least resistance is determined by the always underlying and the usually unseen structure. So your path to the bathroom was determined by the underlying structure, and this is important, the words, by the always underlying and the usually unseen structure. So the underlying structure of this building determined your progress to the restroom. And as you were going to the restroom, you were probably unaware that your behavior was manipulated by somebody you've never known and probably never will know. Question, sir. Okay. Third principle of the science of chaos is that this underlying structure can be determined and it can be altered. Now think about that for a moment and let me repeat those. First principle is everything in the universe is energy. We've known that, believed that for many, many years. Second principle is that the first principle is all energy seeks the path of least resistance. So when you came in, you sat in the seat that gave you the path of least resistance. I mean, you could have come over here and you could grab John by the hair of the head and pulled him out and sat in his seat, but you decided, to sit, it would be better to sit someplace else. The second principle is that this path of least resistance is determined by the always underlying and usually unseen structure. Third principle is that this underlying unseen structure can be determined and it can be altered. So if you look at a stream up here in the mountains and you see the waters rushing very fast, you know that underlying structure, the riverbed, is probably shallow and narrow. But if you see a big expanse of water that's not moving like Lake Mead, then you know that underlying structure is deep and wide. but the movement, the behavior of that water is caused by the underlying structure. Now, as we get to the market's movement is determined by the underlying structure. And that's what we want to learn to trade, and that's what we're here to share with you today. So back to the hydrogen example. All of these little hydrogen organizations are going every which way in this room, and there's also trillions and trillions of oxygen atoms that are going around. They're bouncing around, and every now and then they'll come into the gravitational field of each other. And atoms have gravitational fields just like planets and solar system have. So as this little hydrogen atom comes over here, and this great big oxygen atom, which is 16 times bigger, so it's like comparing a dog to a horse, comes over here and says, hey, hydrogen, I've got some power over here. I think I'll just suck you into my atom over here. And the hydrogen atom says 99 point, and if you follow that with 6 nines, 99.999999% of the time, that hydrogen atom says, no, I don't want any part of that. I've been a hydrogen atom all my life. My granddaddy was a hydrogen atom. That's the way I've always been. Skip it. You know, this just buzz off over here. Don't bother me. Now, 0.0000001% of the time, that hydrogen atom says, well, gee, you know, this might be a new experience. I think I'm going to let go of my resistance and just see what happens. And what happens? They combine. And then what do you have? Water. Okay, now, water is nothing like hydrogen or oxygen, is it? It has no characteristic. It has a lot more potential. It can be a gas, it can be a liquid, it can be a solid. The world opens up for it because that hydrogen atom did what? It said, okay, I'll let go and see what happens. Now, what we're proposing in the market is to get in tune with the market and let go. So one of the things that we look at is that from our standpoint, there are 5 different levels of trading. And these levels are very easy to determine where you are and what you have to do to get to the next step. For example, the first level we call, and these are our labelings, but they are 5 levels, is a novice. And our goal for a novice trader is to be in the market and not lose money while gaining experience. Now, if you're in the market and you're losing money, by our standards, you're not at the novice level yet. The novice level doesn't make a lot of money. The purpose is not to make a lot of money. The purpose is not to lose money. And I happen to be a proud father, and I have 3 children, and two of my children have no interest at all in the market, but one of my daughters does. And she has turned out to be a fantastic tech support person for getting people who have never traded before to get in the market and not lose their money. Because if you get in the market, I'm in this new profession, and man, I'm going to take off, and I'm going to have millions and millions of dollars, but I've got 10 losers in a row. What do you think your psychological profile is going to be? It's going to be on the floor, isn't it? We had a guy at a tutorial recently who said he was a floor-ceiling trader. If the market ticked 1 tick for him, he's on the ceiling. If it ticked 1 tick against him, he's on the floor. Well, that's not a good approach to trading. It's somebody's approach, but it's not a good one. So the novice level is to learn how to be in the market, not lose money while you're gaining experience. At the next level, at the advanced beginner level, the purpose there, or the object there, and the results there, is that you learn how to make money on a 1-contract basis, consistently. Now, you don't go in and trade all your money and this sort of thing. You learn on a 1-contract basis. And once you get to that point, the next level is a competent trader. Now, a competent trader, and from our standpoint, understands the market, knows how to deal with the market, and trades in multiple contracts. And we've had a challenge out that has never been successfully put down, and we've had it out now for almost 15 years. You bring me any system, doesn't matter what it is, any system that will make money on a 1-contract basis, and I will show you how to double your percentage return without changing anything. Using the same entries, the same stop, but we'll double the percentage return by varying the number of contracts. Because if you have multiple contracts, you can be maximally invested where there's minimum risk, and you can be minimally invested where there's maximum risk, right? If you have 1 contract, you're either 100% in or you're 100% out. So if you can do that, what we do, and what some, in fact, what the system that the cab driver was talking to my wife yesterday about was a system that says, okay, you buy silver, and if you make enough money, you margin another one. If you make enough money on that to margin 2, you pyramid. So you buy 1, 2, 4, 6, 8. If you have a big long stream, if you have a big run, you're heavily invested, but your average price is way up here, isn't it? So if the market turns against you a few degrees, you may be out in the cold. What we do is we reverse pyramid. So if we're going into, say, gold or bonds or Iomega or IBM or Dell or whatever, then the first entry will be roughly about 6% of our equity that goes into that. So let's say we're buying gold, and we have allocated that we can stand 15 contracts in gold. The first signal will be a one contract trade. The next signal will be 5. The next one 4, the next one 3, the next one 2. And that way, if it goes up, our average price is way down here rather than way up there. So the market can go against us, and we don't care which way the market goes. And that's always our standard barometer. We ask ourselves that question every minute we're in the market. Do I care which way the market goes? If I care, I get out. Because I've learned if I care, I get under pressure, and I get stupid under pressure. And I buy when I need to sell and sell when I need to buy. The virtuoso, this is at the 4th level here. You go into a whole other world. It's almost a non-scientific world. It's a knowing without knowing how you know. You get so in tune with the market that you actually sort of breathe with the market. I had a wonderful experience fairly young in my trading career. I got to trade with a guy who was 93 years old. And the longer I live, the more I'm inspired by this. He was Secretary of Agriculture in the Kennedy administration. He was about 6'7" tall, big, tall guy, and weighed about 120 pounds. He was sort of like a telephone pole. And he'd look down at me, and he called me Little Willie. And we'd been trading for I went over to his house, and we hadn't been trading for 30 minutes, and he looked down at me and says, Little Willie says, if you breathe like you trade, you'd be dead in 5 minutes. And I said, what do you mean? And he says, all you want to do is suck air. And I said, I don't know what you're talking about. And he said, well, trading is like breathing. You breathe in, you take the oxygen you need, and then you breathe out so some other people can have some. And all you want to do is take profits on every trade, so you'd just be inhaling and never exhaling, and you'd die in 5 minutes. And he was right. He hit the nail right on the head. Then that afternoon, he came at me again, and he said, Little Willie says, man, he says, I'm glad you're not a farmer. He says, you'd go broke on your first crop. And I said, what are we talking about now? And he says, well, if I've watched you trade here today, and if you went out there and planted corn, every day you'd go up and you'd pull the seed out to see how it was doing. And he said it wouldn't work. And of course, that's what I was doing. You know, I was taking the profits too quick, and I wouldn't let them mature. Learned a great deal from that man. That man was a master. At the master's level, what you do is you understand the market so well that you contribute to the overall knowledge of the market, that you contribute to the well-being of the market. Okay, let's go back, excuse me. And what I want to do is, we have found, there we go. Okay. Traders' biggest problem. If you're around many traders, what you'll hear is, well, making money in trading is easy. No problem with that. The problem is keeping what you make. And most traders' income is like a sawtooth. It goes up, 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 and then we lose it all. Up, 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 work, 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 and lose it all. Work, 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 and lose it all. Usually for opinions that we have about what the market is and what the market isn't. And we have what we call 5 grounded assessments. This is the only way we'll get into the market. Now, we use a number of other auxiliary sort of things, and we're going to explain it to you as many as we possibly can. But the first determinant we have, because we believe the market is a real live thing, is we want to know what new information is coming in. Now, if there's not any chaos in the market, there's no movement. Chaos is new information, new incoming information, remember. And if you're in the gold market and there's no news at all in gold, what's gold going to do? It's not going to go up and down. It's going to sit there, isn't it? But it's our perceived information. Well, Y2K, people are hoarding British sovereigns and this sort of thing, and the gold market's going to go up a little bit and it's going to come down. The stock market's going to come down because of the Y2K, and then in January it's going to go up. We don't care. We don't predict. We don't forecast. We trade the market of what's happening now. And we have an indicator, and this chaos math is very, very difficult because it is nonlinear feedback calculus. In fact, if you have a 300 hertz machine with dual pinion and you do the actual chaos math on it, it takes 52 hours to draw one screen because each pixel depends upon the feedback from all the mathematics that are in there. So we had to hire 2 PhDs, one in computer science and one in theoretical physics, and use a Cray mainframe. to determine the math, and then with a Cray mainframe, we did over 5 million iterations to get it to where a PC can handle it. Now, what will happen is if you use a PC to do this, you will miss one trade out of 200 that you would get with a Cray mainframe. And believe me, with a profit of one trade in 200, you can't afford a Cray mainframe to get that extra. And if it takes 52 hours and you're trading the S&P on a 5-minute basis, that's not going to be a big help to you whatsoever. But we have what we call the alligator, because the market is really alive. And the alligator it has a jaw, it has teeth, and it has lips. These are moving averages, which Justine is going to explain to you, but the moving average tells you where the market would be if there was no new incoming information. So the difference between the average and the price tells you the effect of chaos, the effect of new incoming information. Now, I'm going to turn it over to Justine in just a moment, but before we do, this is really important. And I know that you had a big night last night, and you had a good sleep, and you had some sweet rolls and breakfast out there. So I'm going to do just a little bit of an exercise here, and I'd like for you to join me with it. And what I'd like you to do is to stand up, if you would. And I've got two things to ask you to do. One is I want you to do what I'm going to do exactly as I'm going to do it, except even more enthusiastically maybe. And then I want you to keep an eye out for the guy or the gal on your right or left. And if they don't do it right, then we'll ask them to come up and do it solo, okay? And it's just a little poem. I'll tell you what it is. It's, oh, I say, have you heard about Harry the trader? He just got back from the floor where he was needed to trade the bellies. Everybody knows about Harry. Hip, hip, hooray. That's it. And we're ready to go. Now, if you... yeah. And John, if you leave off the H's, you almost sound like somebody from South Africa or England. So would you put your hand up and make an O? O, and then follow me with gestures. I say, have you heard about Harry the trader? He just got back, here we go now, from the floor where it was needed to trade the bellies. Everybody knows about Harry, is it? Hooray! Okay, sit down. Now you're in a mood to listen, right? When I was in graduate school in psychology, one of the things that they taught us was that the anterior can absorb only as much as the posterior can withstand. So maybe we got a little load off the posterior here. And I'd like to introduce you to one of my favorite daughters, Justine, who is a great trader, believe me, and a good coach. And neither of us work microphones well. They're going to love us. That'll do it.
Good morning. Thank you all for coming. It's kind of a tough act to follow when he does that, but I'll give it a try. One thing that I want to talk about or mention in trading is I find that I've been very lucky in where I've kind of ended up. I spent many years cutting hair. I went into nursing and came home to further my nursing degree and saw the screens, saw how visual it was, saw the colors, and went, wait a minute, that's not mathematical. I don't have to have an engineering degree, and I don't even have to like math to be able to trade, because that was one of my biggest problems in life. I hate math. I'm a visual person. You can show me something, I can do it, but if I have to read it and try to figure out the directions, it takes me days. So it was really neat. I started looking at screens, and I started seeing the colors, and I started seeing that there were visual patterns, and then the charts weren't necessarily open, high, low, close, Fibonacci retracements, percentages. It was really visual. It was colors. It was pattern recognition. So that was my entry into the market. I had been around it all my life. Never had an interest until very late in life, but I'm very glad I did. One of the first things that I came around to was the alligator. That was something that we were looking at. The alligator has many functions. It's a wonderful tool. The first thing about it, it's very simple. You're looking at moving averages. That's what they are. They're smooth moving averages, and they're offset into the future. Yes, I'll explain further in just a moment. Okay, one of the problems, or one of the things that I do is I spend a lot of time working with our clients. We teach people how to trade the way that we trade, or our methods, not exactly how we trade. The biggest thing that you'll find in the markets is that everyone trades differently. I truly believe and have found through the last few years of trading that there's no such thing as a system that really will work. It will work for a period of time, but I have never seen a system work over time. If they did, you wouldn't be here. We'd all be trading a system. We wouldn't be looking for another one because you had one that worked. And on the same side, if we had a system that really worked, there would be no futures markets. We couldn't have it because we must have an equal balance. Every time I buy, someone must sell that contract to me. So it has to be equal. When we look at the stock market's a little differently. We're looking to build wealth. As a country, we're creating more wealth in the stock market. With the futures markets, we're not. Someone's always winning and someone's always losing. There's always an equal balance. So it's something you have to think about. A lot of people say, oh, you trade the futures markets, why not stocks? Well, I have a lot more leverage in the futures markets. I can get I have a lot more access to money for a smaller amount, a smaller margin. The stock market has become explosive with what we have with the internet stocks and with day trading and what we've found with all the different internet brokers, and there's just so many things that are coming around that I can't keep up with them. But I do find that what's interesting about what we do is it doesn't matter if you're looking at stocks or commodities, it works on any time frame, on any level. It works whether you're an aggressive trader or you're a conservative trader. And that's what I want you to really get while you're here. We all trade differently. We all trade our belief systems, period. My stock may be comfortable for me. It may not be comfortable for you. You may want to go in with 10 contracts. I may want to go in with 5. We're all going to be different. I may take profits before you tend to take profits, but that doesn't mean it cannot work. What's so wonderful about it being based on the chaos theory is that it does work differently for everyone. Now, not everyone, I'm not saying that every trader that comes to us is successful. I cannot tell you that. But I can tell you, most of them that are not successful, I can tell you why they're not successful. And it's psychology. It has nothing to do with what they're doing. With the actual indicators, it's the psychology. Most traders that come to us have been around, have had some systems that have failed, have lost money. By the time they get to us, they're either, I can think of one specific guy who had 28 straight losers, 28 losing trades in a row. That's pretty hard to get back up and get in there and call your broker and place another order after you've had 28 losers. I don't know that I could. I really don't know that I could. He is a great guy. He has hung in there. But when you're trading, you've got to be comfortable. You must understand what you're doing. No one is going to take care of your money like you will. You can give your money to a broker here. That's good in one sense because it takes all the blame off of us, doesn't it? I didn't make that decision. I didn't put that losing trade in. My broker did it. I didn't know. He's supposed to do that. That's his job. Most brokers wouldn't be brokers if they could trade. And remember, whether you're making money or not, your broker's making money. Every trade that's placed is a trade for him. The average commodity trader lasts 3 months in this business. Do you all know that? 3 months is the average. That's nothing. I mean, that is a very short amount of time to lose the amount of money that you have probably saved up, or you could have done something else you think with it would have been productive. $20,000 might have been a great addition to your house. Might have been, not a new car, depending on what kind of car you want, but might have been a car for your child. So when we look at the markets, I look at them from a very wide approach. I spend most of my time working with our clients. Dad mentioned earlier, 50 to 60% of our clients seem to be doctors. And I used to be a nurse, so I understand what's happening with the HMOs in the medical field. We're looking for a way to get out from under that control with someone sitting behind a computer saying, yes, you may do that test. No, you may not do that test on this person that you've never seen, know nothing about, and the person behind the desk doesn't even know how to take blood or take blood pressure. I mean, it's amazing to me. So we're trying to find other ways to get out of under. Uncle said that, all of these things that are happening, we want to be independent. I have great pleasure in doing what I do because I am enabling, most of the time, helping people to become independent. To not look at someone and say, thank you for this paycheck this week, or excuse me, I need Friday off, I have something I need to do. When you're trading the markets, that doesn't happen. Guess what? I don't have to trade today. I don't have to trade tomorrow. I can come back in a month and it's happy that I'm there. It doesn't care I was gone, doesn't even know I wasn't there. So that's what's really neat about it, Say this week you need a little more money. You go to your boss, can I work 45 hours this week? I need 80 hours this week. I need a double check. You can't do it. The markets put 2 contracts in instead of 1. Your risk is doubled, but also your potential profit has doubled. So the markets can be a really, really wonderful place. You don't have to necessarily risk huge amounts of money, and there's other times when you can risk everything you want. It is up to you. My goal in what we do is to help facilitate you through those 3 months, 6 months, 3 years, 5 years. I have some clients that started with me before I started, and I'm still giving them tech support. We still talk. Sometimes it's once a month. Sometimes it's every 6 months. It just depends. But what we do is we're consistently and constantly looking at the markets and trying to change with the markets. If a system would work, then that would tell me one thing, that the markets stay the same, basically. If one system would work and consistently work over time, then the markets would have to be staying the same. What we find, they don't work because the markets are always changing. So we have to be able to change and grow with them. In my last 3 years, I've seen a few things that are different in the markets. I've seen volatility change, the amount of people come into the markets, the way certain markets move, the personalities of these markets. These are all the components that we look at. I look at you, what kind of trader are you? What are your belief systems? Are you an aggressive person? Are you a more conservative person? Should you be trading the S&P? Are you only going to get satisfaction out of trading a 5-minute S&P and making money? Some people, if you said they had to trade an S&P, would panic and hit the floor. Others, that's what they have to have. So when you really get down to it, it's psychology. And it's very hard it was hard for me to understand that in the beginning or believe it. It seemed that this is all about money. This has got to be about money. Well, the end result is money, but between here and there, it's what's happening up here. Most traders that I see that have a hard time are fighting or trading their old trades. Or they come into the silver market, silver took $1,200 last week, so now I'm coming in and guess what? I need my $1,200 back. Isn't that the first thing you say? You're now telling the market to give me my money back. Well, guess what? It's not your money. That money's gone, and it will never give you that specific $1,200 back. You may get another, but it won't be your original. So you have to when you have a losing trade, you must learn and let it go. Biggest thing. Once you've lost, look at it. Is there anything you can learn from it and move on? Because it'll never happen again. The exact same thing won't happen again. You won't be in the exact situation because the markets don't repeat themselves exactly. Now, what I think happens to most of us, this is a typical example. The bracketed range-bound market, you see the up and down points. So say you go long, at the first point, market comes down, you get stopped out, you have a loss, you go short, market comes up, you go long. We're following this, right? We're going back and forth. We're in, we're out, we're long, we're short, we're long, we're short. We've had 7, 8 losses, so guess what? We're not in it, are we? We're out. The next trade, market takes off. And you're mad. You're really mad. Here went your money, you've lost $5,000 in the interim, and the market's taken off, so what do? Now you hop back in at the end of this trend and go back into another correction. Okay? Or you leave this market and hop into another one that was trending because you think, here I am, and it goes into a correction. This is what we do. We're chasing the trades. We're chasing the markets. So my goal, knowing that markets only trend 15 to 30% of the time. Think about that. That's not much. And if you have to be in the markets all the time, 70% of the time, let's say, you're in a market that's range-bound that is difficult to trade. But most of the time, corrections wave forth. I don't even trade them at all. I recommend to my clients not to trade them in the beginning. Because if you know that is where 85% of your losses occur in wave 4s or corrections, why be there? It seems like common sense to me. Stay out. But part of that is you have to be patient, and you have to look at the markets and pick your trades and let the market do what it's going to do. Don't force your will on it. Place your orders and let it go. Because my orders really have no effect on what's going to happen in the market. It affects me. So what is the alligator? The alligator is a wonderful, wonderful tool, and it's a very easy one. It's an integrated approach to monitoring the market's momentum. Now, what I want to say to preface that is that when we're talking about the market's momentum, we need to understand what really moves the market. When we're looking at what moves the market, it's all of us as crazy traders placing our orders, getting in. We create volume, don't we? That volume, in turn, then stimulates and accelerates the momentum. So the acceleration of the market starts to increase when we get in there. After the acceleration increases, then momentum starts to roll. And we start rolling, we have momentum, increasing momentum. After momentum, then we see a price change. So what that's now telling me is that I can see ahead of time what's happening before the actual price changes. It's pretty cool. I mean, it's pretty cool. I kind of like that. Having a little bit of an advanced warning, and I'm going to show you some other things that we use that really do actually show you the acceleration and deceleration of the market's momentum. So it's an integrated approach to monitoring the market's momentum, and it's a simple indicator to trade only with the current trend. If nothing else, the alligator, you can look at a chart in 1 second and know what side of the market you should be on. If nothing else, it could do that for you. And it's that easy. The third is it's a protection device to not lose money during bracketed markets. That's a big one. To not lose money during bracketed markets. Or to not lose so much money during bracketed markets that you will not be there when the trend takes off. Yeah. Bracketed market meaning range bound. We're not looking at much movement. We're looking at more sideways where there's not much money to be made, but you can certainly give it up when you're going back and forth.
If momentum involves volume and price, don't you need someone buying to fuel momentum
buying or selling. We can have momentum to the upside or to the downside. It can go either way.
How can you tell that ahead of time if it's dependent on someone buying or selling?
Well, when we see the orders come in, that is what's creating the volume. That volume, in turn, starts the momentum. What we'll look at later is I'll show you the oscillators that I have that read that. Maybe that'll probably be a little bit easier. Okay, so that's what the alligator does. It's an integrated approach to monitoring the momentum of the market. It's a simple indicator to always know what side of the market to be on. And it's a protection device not to lose money during bracketed markets. And this is our lovely gator we have up here. It's kind of at the office. The office is in Mom and Dad's home, so the second story is all office, and it's over the water. And we have different clients have brought us gators from all over the country. We have a woman coming next week that has done a 8-foot alligator. It's incredible. She has to come and actually set it up in our office. It's so huge she can't ship it to us. So the alligator is kind of our neat toy, but this is him on the screen. And we're looking at 3 different lines. We have a green line, a red line, and a blue line. Green line represents the alligator's lips. Red line represents the alligator's teeth, and the blue line represents his jaw. Now, we've done this, you know, from school. The stupider the things, or the sillier the things are, the easier they are to remember. And it just happened that with the gator, you think about his mouth. You never want to get caught in the gator's teeth. And I'll show you as you go on. So we don't want to be caught, the price action, inside of the gator's mouth. Now, let's talk about what the gator is. My dad explained earlier that it is the place where the lines are. We call these the balance lines. Okay, so we're looking at the alligator anatomy. As Dad mentioned earlier, they were created, or the mathematical calculations were done by the Cray mainframe, millions and millions of iterations. So the work that's been done for this to enable us to look at it on our computer has been done and taken care of, which is great. Different software programs some of them have different mathematical formulas and calculations, probably as most of you know. TradeStation is a little bit different than Metastock from CQG. They all vary in their calculations. So you may have a hard time if you're trying to copy these to be exact, depending on what you're using. We do supply the indicators for certain TradeStation supercharts and some others that come with our course, but we'll try to help you if we can create these. So they're smooth moving averages. The green line, which would be the lips, that is a 5-bar smooth moving average offset 3 bars into the future. Now, what I'm saying with a smooth moving average, the difference between a smooth and a simple is that you would subtract the average instead of subtracting the first entry. Okay, so that would create the smooth, and it is a big difference. If you put the lines on and you see the smooth compared to the simple, the smooth is going to take out a lot of the noise. Now, yes, sir?
When you say smooth, are you talking about an exponential moving average?
No, this is not exponential. This is a smooth. So instead of when the next entry would come on, you would subtract the average instead of subtracting the first entry.
Subtract the average.
The first entry, yes.
For example, if you have five entries into an average, so if you had all 5 of them and you added the 6th one, you would add the 6th one and you'd subtract the first one, right? That would be a simple average. So instead of dropping the first one, what you do is you drop the average of the 5 from that 6th one. That's all. It's a very simple way, but it's neither exponential or simple. It's a smooth moving average. And if any of you have any problems with that, just email us or call the office, and we'll ship out an email or we'll give you a page.
I have something that can explain it as best as I can. Now, the other problem for me, again, as I mentioned, I am math defunct. I hate math. I don't like anything to do with it. Letters and numbers. Elliott Wave was a real problem for me in the beginning because numbers and letters were there. I thought they should not go together. So I will do my best to explain. Sometimes Dad has to step up and do that for me, but I know it works, and I know what the numbers are, and I know why they work, and that's all that counts to me. Now, the red line, the teeth, would be the next. This is the balance line for one significantly shorter time frame. Now, I'll get into that in just a minute. It is an 8-bar, smooth moving average, offset 5 bars into the future. Yes?
How do you get into the future, 5 bars?
Question is, how do we get into the future? What is happening, that's part of the mathematical calculation. It is projecting 5 bars into the future where these lines are going to go. And that's part of what's so really neat about the alligator is that you may have the price bar ending here, but the alligator is projecting, so we're seeing if the market's opening, closing, or what it's doing. And we'll look at that as we go along.
A bar being a day?
Well, each one's going to be different. If you're looking at the lips, it's projected 3 bars into the future. The teeth is 5 bars into the future, and the jaw is 8 bars into the future.
But it doesn't matter what time frame it is. Because the minute
minute chart would be 5 minutes in the future. Okay. Yeah.
Yeah, it doesn't matter what, it's all constructed from one data source. You don't need live data to do this. You don't have to have 5-minute data, 30-minute. It can happen from one data source. Mathematically, it will figure out these 3 different time frames. So when we're looking at these, the blue line, the jaw, called the balance line, that would be where the market would rest on the current time frame you're looking at if there were no new coming information. So if there were no new orders coming in, that's where you'd see the market. The price action would be resting right there. Now, the green line, excuse me, the red line, the teeth, would be the next time frame. That would be for one significantly time frame, one shorter time frame. So if you were looking at a daily chart, the red line, the teeth, would represent roughly an hourly chart. So if that's where the price action would rest if there were no new coming information on an hourly chart. And then the green line, finally the lips, that is another shorter time frame. So we're probably looking at maybe a 15, 20-minute chart if we were looking at a daily. So we have the daily, the red line looking at about an hour, and then probably roughly 15, 20-minute chart. So that's allowing us to see what's happening with the market. Now, the next thing that it does, which is pretty incredible, is this is it on the chart. So what we're looking at, it's very simple. You always want to be wherever the green lines are. The alligator will turn around. In an up market, the lips are going to be closest to the price action. So we always want to be outside the gator's mouth. If you think about the gator and the price action being fish, they're always jumping away. We don't want to get in the gator's mouth. We want to stay outside of the gator, clearly. So the green line should always run, if you're in a trend, with the trend bar. So in 1 second, when you looked at that chart, you knew you wanted to be long, didn't you? I mean, there was no doubt, no question, any point in here of being short. You want to be long. It's very simple. It's clear. It's visual, and that's what's really interesting. Unfortunately, we don't have live data here. CQG does have live data at their booth, and our indicators are on them. You can pull up any time frame, any stock, any commodity, and you'll see the gator, and it's fantastic. It's absolutely fantastic. Usually we have live data, so at the end we can go through and pull up anything you want to look at, so you don't see that we've just brought pristine. I've tried to bring some examples that have true cyclic markets, pullbacks, corrections, so you can see how it actually happens all the time. Of course, in any big trend, it's always going to look beautiful, but we also want to know how it works in the real markets when it's not trending, since they don't trend all the time. So the alligator's here. We've got him on the chart. What we have here, we see that these 3 lines are together, converged. This is what we're talking about as a sleeping alligator. The alligator is sleeping. He's taking a nap. He's intertwined. He's twisted. Now, we have a couple different scenarios here, and I'll show you later on what helps to combine this. We also have some oscillators that we're going to look at that help look at that for an entry point. But we have a sleeping gator. When we look at the sleeping gator, we get excited because the longer the market stays condensed, and in a tight range-bound market and nothing is happening, the bigger the move is going to be when it comes out. Period. The market cannot stay doing nothing forever. It wouldn't be a market. So the longer it stays in there and just gets wound tighter and tighter and tighter, usually the more explosive the move comes out of there. So when we see a sleeping gator, we get really excited. Now, what's kind of unfortunate is in the last year or two, I have noticed that there are not as many sleeping gators. The markets are more volatile. There's more participation. So we don't have a chance to see them as much as we used to. Intraday you do, but on a daily chart sometimes we're coming in, we finish a wave 3, and boom, we swing straight up into the A wave, and there really wasn't a sleeping gator in between. So we've had to adjust in the last couple of years to look for. Sometimes the market's not always sleeping. And we always let our clients know that. That's one thing we do. We want to keep you up with what changes and what's happening. Did you have a question? No? I thought I saw your arm a minute ago. Okay. I'm going to skip forward one slide, which would be skipping to page 18. I wanted to talk about the fractal definition so you understand how we get in the market before I go on and show you where we are in the market. The fractal pattern is something that we look at. It's one of our first entries. It is the first entry into the market. The fractal is very simple. A fractal, basically, the only way fractal is anywhere is a change in behavior. That's what we're looking for. A change in behavior is a fractal. So when we're looking for the fractal here, a fractal definition is 5 or more bar sequence where the center bar or group of bars are preceded and followed by 2 lower highs for longs or 2 higher lows for shorts. Swipe all that out. Put your hand up in front of your face. Hold your hand up. That middle finger, that's a fractal. Okay? You've got 2 lower highs on each side. This is a pristine fractal. So that's what we're looking for, the 5-bar sequence with the highest high in the middle. 2 lower highs on each side. Now, flip your hand upside down. That's your cell fractal. You have the lowest low with 2 higher lows on either side. So that is a fractal. Fractal definition. 5 bars, can be more, but 5 bars with the middle bar being the highest, 2 lower highs on each side, or 2 higher lows, depending on a buyer cell. Now, go ahead and go to here. Skip to the next one. Now, this is the fractal pattern just showing you. So you know you have A is a pristine fractal bi. B is showing you we have a bi and a cell pristine. So that middle bar is functioning both as a bi and a cell. Now, inside the C, you notice that we have an inside bar. We wanted to show you that you can have inside bars and it does not ruin your fractal pattern. So sometimes that'll make it a little trickier. Most of the time, a fractal is very easy on any chart. If you have a chart using high, open, low, and close, all you got to look for is that point sticking out. It's going to be a change in behavior. Now, how many of you are familiar with Elliott wave here? Okay, a few. When we're talking about Elliott wave, you will always have a fractal at each beginning and end of an Elliott wave. We're talking about a change in behavior. So after you've had a big wave theory up, there'll be a fractal on the top and a fractal on the bottom when you started. So you will always see a fractal. There's a change in behavior. Now, and then D is also another fractal, and we're just showing you again there's an inside bar, so it's not pristine, but that highest bar at D is a fractal. Now, what I also want you to see is these 2 bars are equal. Where the caret is and 2 bars over, those have equal highs. So it took the one to the left and then the second one to create a fractal because of the equal highs. So I want to show you that fractal because the fractal is our first entry into the market when we combine that with the alligator. Now I'm going to go back 2 slides to trading the alligator with the first fractal buy. Now, I want to discuss some rules about the alligator and the fractals. The first thing we're looking for is we've said that we don't want to feed the alligator. We don't want to be in the alligator's mouth. So definition, it's kind of tricky. The definition for a valid fractal is that it must be hit above the teeth for a buy or hit below the teeth for a sell. Now, sometimes that can be tricky because the fractal at this point, this first caret was formed, it's not a valid fractal, is it? It's a cell fractal, but it's completely above the mouth. So it would not be valid. Wouldn't take that. So there are signals, just because a signal is created, it also doesn't mean that we take it. We always going to look at market conditions, what's happening, where are we in the Elliott wave, what is the market telling me, what's the alligator doing, what's its behavior. So we look at many different things. We are not a system, we are a systematic approach, would be a better term to use. Okay, so at this point we're looking at the fractals. Your second caret down is a cell fractal. Now, in this case, you actually have a bifractal and a cell fractal, don't you? Your first up move at the beginning of the chart is an up fractal. And then we have the down fractal. So what we like to do, and we call it the spider web approach. In spider web approach, a spider spins a web and just sits back and waits for the flies. I mean, she doesn't do anything with that. She spins a web and waits for them, and then when the fly comes in, she goes and gets it, takes it out. So we kind of look at the market like that. We spin a web. We put our orders in, buy and sell, and wait for the market to do what it's going to do, and not care which way it goes. I don't have a lot of interest in it when I have a buy and a sell in. I'm willing to go whichever way the market goes. I'm there. If the market is a dog, I want to be its tail. I want to follow it. Okay, I want to be right wherever it goes, most of the time. Okay, so here we have a sell, and to tell you the truth, if you look at that sell, now let's talk about how a fractal gets initiated. Just because we have a fractal form doesn't mean we're in the market. The fractal must be hit. So in other words, the fractal, say we had a fractal buy at 1800, the market would have to hit 1801. Say buy was at 100 even, it would have to hit 101. So the market has to come back and retrace to hit that fractal. And to create a fractal, we have to have 2 lower highs or 2 higher lows. So there is going to be a sort of pullback. Now, when you look at some charts, you're going to say, your fractal is probably not your best entry point trade location. But the fractal will guarantee that you will never be left out of any significant trend. I've never seen a significant trend move that there was not a fractal for entry, ever. And I've seen a lot of charts. Look at a lot of charts. So it may not be your best trade location, but it's going to be a safer entry point. When we combine the fractal with the alligator, to me, I would rather be a little late coming into the move and knowing it's a move than taking every shot there is and being stopped out and having loss after loss after loss after loss, even if they're small losses. Psychologically, after 15 losses, I'm probably going to back out when the real big move takes off. What I have found is that your biggest trades, the trades that make the most money are the trades you thought were going nowhere. The trades that you didn't even think about, the trades that you knew were going to be the big one. This is it. If you look back, most of you will find they didn't go much anywhere and turn into losers. It's the expectations we put on them. This is going to be the trade. This is it. Market's like, no, it's not, and you don't know what it is. You don't know until I tell you what it is. So I've really had to learn to give up being right and having so much of an opinion as to I would rather follow the market and make money. I don't care if I'm right or wrong. I want to be there and feel comfortable with what I do. If the stop that I'm placing, if the signal that I'm using is not comfortable, I can't repeat that trade. How do I go back and make that decision again if I'm not really trading my belief system? If I'm following you, I can't repeat how you trade because that's how you trade. If you're following me, you can't repeat that. I have clients that say, well, can I follow what you do for a while? I'm like, no. What good does it do you? None. I will work with you every day. I will look at your trades. I will talk to you about them because I need to know how you trade best, not how I trade best. Because my success has nothing to do with your success. And that is the truth. And most people that teach and are here to do what we do will tell you, oh, everybody will do well. That is not true. I'm not going to lie to you. I cannot stand here in front of you and say everybody here could do well. It depends on your psychology. It depends on what you want and what you're looking for and what you're willing to give up or let go to get it. And giving up is very difficult. The more knowledge you have, the more systems you know, the more patterns you know, the more the CNN reports you read, the harder it is for me when you come to me. It is so much harder. Some of the most successful people I've had have been, there's been some women that have done really well, because there's really not much ego involved for some reason. They just, okay, it's easy. And the people that knew nothing, that really had no market knowledge, that came to the market fresh, green. They had nothing to unlearn, and they were just willing to listen and learn, and they had nothing to say, well, this looks better than that, and I was told that this chart, this formation looks like something else, and then you start pulling in all our opinions. And now we're trying to say, oh, because this looked like that, we're assuming it is. Well, you can't assume that. Just like with Elliott Wave, Elliott Wave is an ungrounded assessment because the markets are never the same. We have Elliotticians and different types of Elliott counters, and the old joke is you can put 8 Elliotticians in a room and get 16 counts. Well, it's true. It's true. And the problem is that the markets do not repeat themselves identically. So if they don't repeat themselves identically, that's why the Elliott Wave is ungrounded. I know there's a 5-wave pattern with a 3-wave correction, but do you know how far it's going to pull back each time? So here we go. My opinion says it's going to pull back 62%. Yours says it's going to be 50. So who's going to be right or wrong? We don't know until it happens. So you only can count. I can count Elliott Wave perfectly in hindsight, and I'm pretty good in real time, but it's still, you have to be willing to say, hey, this market can do anything it wants. Look at the personality. When I'm trading the S&P, I don't trade the S&P, actually, I trade the Dow. When I'm trading the Dow, I don't treat it the same way that I treat cocoa. I don't treat gold the same way that I would treat the bonds. They all have different personalities, and you have to trade them accordingly. So when we're looking at charts and we're looking at things, I take into account Elliott Wave, I take into account market behavior, I take into account my account size. If I have a $15,000 account, I'm not going to be hopping in silver, the bonds, and the Dow my first day. I need to trade the graves. I may need to trade some Canadian dollars. I need to trade markets that are calm. So I learn how I trade. Because in 3 months, if you're out there trading everything and you have nothing left and now you think you know how to trade, well, guess what? You don't have any money to trade with. So what good did the learning process do you? To me, the most valuable thing, I think, what I do with our clients is say, hey, the markets will always be there. Learn how you trade. Learn the markets. Paper trade. It's never the same paper trading, but you get an idea. You get an idea of market behavior. You must understand what market you're trading. How does it trade? Is it a market that tends to run? Is it a market that tends to hit a signal and go the other direction? Is it a market that tends to get in a trend and run for months? Is it very choppy? Is it like silver and goes up 6 cents and then drops 14? What are we looking at? So all of these things that we put into our trading and help us become better traders. So this is the fractal is a grounded assessment, by the way, and this is where we're going to get into the market. So that's the first entry, point number 1. And if you notice, point number 1 gets hit on the bar at number 2. The market comes back up and takes out that high. So we're now long. Yes, the question was about the fractal and the lips. In order for a fractal to be valid, it must be hit above the teeth, red line, for a buy. And for a sell, it must be hit below the teeth. Now, the fractal may not be formed when the time the fractal is formed, it might not be valid. But later, like this is an example, this fractal is not valid, is it? Would not be hit below. Skip all that and let's just say we came over here. That fractal would become valid once it went below the red line. But now, between here and there, we've had more recent self-fractals, so I'm going to use what's the most recent information. But you have choices, and that's one thing that's great. We do have choices. Now, the next thing, what I haven't mentioned to you, and the other real important fact about the alligator is what else it does. Besides us knowing where to be and entry points, we use it as one of our exit techniques. It's not the only one, but it is one of them. The alligator, we look at when you're trying to stay in a trend or trying to be on the right side of the market, we use it. We enter from here with the fractal. Now we're going to start using stops. When we talk about the stops with the alligator, we have two. We have a red line and a green line. Real simple. Kind of can guess where they come from. The green line stop is my stop of choice. I like it because it's a little more conservative. The red line is probably Dad's stop of choice. And again, we trade the same methods, but we trade differently. I'm a little more conservative than he is. He's got 40 years at it. You know, I can see him take a loss or two, blow it off his shoulder, and he's back in, and the market's taken off, and he's there. I can have a loss or two, and, you know, well, okay, and let me look at this again real well. You know, I still am dealing with my psychology. I'm human, you know, and as I teach and as I work with our clients, and I do consulting, and I teach advanced classes, and I do a lot, it's so interesting to see how I've changed in my thinking in markets. You know, and how my reactions have changed by working with others and by working with my psychology and knowing, hey, this is what the markets do. It's not necessarily me. This is the markets. So when we're using the stops, it depends. The red line stop, if you're trying to stay in a trend move, if you really want to stay in a trend and you feel like you're in a third wave or in a big trend, we'll use the red line stop in the beginning. Now, personally, as time goes on, if you're adding on contracts and getting heavier and heavier vested, if you've gone long here and been adding on all the way, when you get to this point at the end of the chart, if you had to stop at the red line, that's probably not real comfortable for you, would it be? Not comfortable now, because if I get stopped out at the red line, I'm giving back all my profit. Ouch. There's nothing worse than having a great trade and giving it all back. I have a hard time with that. So in the beginning, we may use the red line, and as time goes on, we have more and more contracts, you may find that we'll come off of the red line and change it to the green line. Bring it a little closer in. Now, I don't have all the other things here to show you, but I have other stops to use as well. So at the time we got up to the top, we may have said, okay, I've got 16 contracts, I've got 10 grand in profit. I'm locking some of that in. Because the other beauty about it is, guess what? You can always get back in the market. It's a phone call away. You can exit and enter at the same point. You can sell at the market and then say, buy me one back if you want it. You can close out, take your profit, and go back in. There's so many options. You're not limited. So here at point 1, we went long. At point 2, guess what? Red line or green line stop, what happened to us? Got stopped out. We had a loss, didn't we? Next, point 2 is a fractal, isn't it? It's also a fractal buy. So what happened a few days later? No. We went long here, got stopped out, because remember, this has to be hit. So this fractal buy gets hit on that day. Just take your finger across from the fractal and you find the top, the bar that allows it to retrace to that point. That's where your fractal entry is. So we're back in the market and we're long. So we had one loss. You know, I'm not here to tell you that we'll get in the market and never have a loss. You are going to have losses. We want to have small losses, quick losses. We want to get out of our losses fast. We want to stay with the market when it's in a trend. So at this point, we have point 3, point 4, point 5, and point 6 you could have added on. Now, these are just fractal add-ons. We have 5 dimensions of the market. We look at 4 other ways to get aggressive and to continue getting into the market, continue adding contracts depending on how we're trading, what account size we're trading, etc. So this is your first fractal buy. You were stopped out once. We're back in at point 2. A green line or a red line stop all the way would have been quite comfortable. Any questions? Okay, we're going to skip the next 2 slides because that was the fractal we'd already discussed. And we're going to the sleepy versus hungry gator. Okay, this is a Eurodollar chart. And what I've done here is just kind of, you see the boxes and the different arrows. We've had to, here you know what colors they are, but for the people in the books that aren't attending, we had to kind of point to everything it is. So it's limiting me. I can't use a laser pointer, and I apologize. I'm a little, less active as I'd like to be here, and I kind of have to make sure everyone on the tape can understand what we're talking about. So we've got Hungry Gator. In a Hungry Gator, your goal is to be as aggressive as possible. In this area, you take all opportunity signals that are in the direction of the trend. Remember, you never take a signal against the gator. Simple. Period. Sleeping Gator, your main goal is to stay afloat in order to catch the trend when it occurs. The fractal must be your first entry. You may sustain a few losses, but you're guaranteed not to be left out of the trend. We have what we call these areas as the low rent district. You've got to pay our rent to be able to get in the market. Now, I've had a few emails here and there that say, that low rent district is kind of being like a penthouse in New York, and I'm not sure what to do. It's getting a little more expensive. So we have to adjust, we have to alter, look at the markets. This is where some Elliott wave comes in. This is where, look at market behavior. If you know you're in a bracketed market and it's difficult to trade, then guess what? Maybe we're going to start looking for the overall trend. If the overall trend is up, then I'm going to be interested mostly in my fractal buys. I'm not going to be interested in fractal sells. If I know that the downtrend is going to be a corrective move, and I don't really like to trade corrections because 85% of losses occur in corrections, I stay back. Put my buy in, and I patiently sit back and wait until the market goes. There's nothing else I can do. With those fractals, we have the opportunity. And remember, a sleeping gator comes the biggest moves. Now, this was a sleeping gator in this first box. Broke out a little bit, went back in. So as you can see along that move, we could have sustained a few losses. None of them were very large, very small. Now, when you add some of our other signals, I can tell you we were in here, we were out at that point. We went back in again. We had a fractal at the beginning of this box and a fractal here that had you back into the move. So that's what we're looking for is fractal entries to get us in and to be on the right side of the gator. The sleeping gator, again, when it's condensed, we're looking for a big move. Here's that move straight out of there. Normally when you see the alligator wide open in this formation, we're looking at a wave 3 or a C of some degree, 1, 3, or 5, or wave C, an impulsive wave. I personally do. I always look at, I'm sorry, the question was, do I determine where I am in the Elliott wave before I get into the trade? And that's a good question. When I began trading, no, I didn't. And what I found after trading for a little over a year is that I needed to know some Elliott wave. I look at Elliott wave, I use it as an atlas. Pretend it's my atlas. I don't use it as a street map. When I get to Las Vegas, where do I turn right and left? I just want to know, what am I expecting? Is it dry? Is it cold? Is it oceany? Is it choppy? Is it the big terrain? That's what I look at Elliott wave for. What can I expect from the market? Because I know Elliott wave is ungrounded. It's never exactly the same, and there's you have to leave a lot of room for error. Now, we count the Elliott wave very differently than everyone else. We count the Elliott wave off the AO, which I'll show you shortly. It's our awesome oscillator. It's a 534, simple moving average, and it's incredible. It's absolutely incredible. So we count Elliott wave off the oscillator, not off the price chart. That simplifies a lot of things. So yes, I do look at where I am in the Elliott wave before I enter, any time before I enter. If I am in a correction, I'm more conservative. I use outside fractals. If I'm looking for a new trend and I've seen a real clear ABC, I'm going to use a closer fractal. So I do let that influence my decisions. The question was, do I use multiple time frames on the Elliott wave count? Sometimes. If I don't see where I am very clearly on the daily chart, I'll go to a larger time frame. If I'm trading a 30-minute chart and I'm trying to see if I've finished 5 waves, then I'll go down to a smaller time frame and see if I can count the 5 waves. So I can do that. I don't want to be an Elliottician, and I don't want to scare people, make you think you've got to be an Elliottician. You don't. You need to be able to recognize some patterns. 5-wave, 3-wave corrections. It's not a big deal. I don't spend a lot of time, but it's good basic knowledge to know what you can expect. That's all. What kind of behavior? Sleeping versus hungry gator, another one again. And what I didn't describe earlier is this was a saddle point, one thing we call it. When the alligator's asleep, all 3 balance lines are intertwined very tightly with the price action. That's a sleeping gator. Again, we get excited. If you notice here, we have fractals above and below, all the way. You have fractal sells, you have fractal buys. You actually have one fractal buy that would have been hit, you'd have been long, stopped out, and then your fractal sell was hit, and you were coming down.
Thank you. This is the last 30 minutes? Okay. All right, back to this. The sleeping gator that Justine was talking about is you don't have to know the Elliott wave to trade the Elliott wave. If the price is outside the alligator, you are in an impulsive wave. If the price is inside the alligator, you're in a corrective wave. And in all wave fours, the alligator will go to sleep. So the alligator gives you some insight into the Elliott wave. The Elliott wave is a good ungrounded assessment. We use it all the time, but you don't have to know it. And we have a lot of traders who trade very successfully who don't know anything about the Elliott wave and who do not want to know anything about the Elliott wave. Now, for those of you who have some interest in this, we have a website, and on the website we have our proprietary indicators, our proprietary software called Investor's Dream. And you can download that. It's free. It has a guide in it that will teach you a great deal about what we're doing here today, and it has sample data. And the sample data, I think there are about 40 or 50 pieces of data or different commodity charts and 40 or 50 different stock charts. And one of the things that Justine was mentioning is that everything we're talking about here today actually is more precise in the stock market than it is the commodity market. But the commodity market has much better leverage, so if you have a successful way of trading and an X amount of money, and you're trying to multiply that money, and you can trade well, you're going to do it much faster, more efficient in the commodity market than the stock market. But if you have a 401k or IRA or something of this sort, trading in stocks, this is very good. But just go to our website. All the addresses are in your notes there. And if you have any questions, don't hesitate to email us or call us or fax us or whatever. Okay, so here we have an interesting thing on this chart. The sleeping gator is also called the saddle point. We'll show you that in a moment. But notice that you went long first. Now, we got out of that long at that top bar, and we'll tell you why and how we did that a little bit later. So that was not a loss. But one of the characteristics of a lot of markets is just before the big move, it will go in opposite direction. I don't know if you've noticed that or not. It's kind of like backing up to get a head start. So one of the differences between Justine's trading and my trading, and I have more losses than she does because I participate more in the low rent district. And she doesn't like to do that, and she waits. And she's the best, honest to goodness, the best I've ever seen at taking traders with not a great deal of capital and getting them started without losing their equity. So the teeth, and it was her idea when she was first learning, that she looked at this. Justine learned to swim before she could walk, but she's always been a water baby. But these were fish, and the alligator's going after the fish, and the fish are trying to jump away from it. Let's go further and look at another chart. The charts, all charts cycle, and you can also chart the cycling of a chart by the alligator also. And notice here that it goes up in the sleeping gator, and then it comes down. You'd want to be long, you'd be short here, long in the middle, and then short at the end. And the market creates a cycle of trending and correcting. The gator allows us to follow the cycle rather than having to predict. We're not the least bit interested in predicting. I get calls all the time from magazines and newspapers and radio shows wanting to interview and saying, what do you think the Dow's going to be? You know, at the first of the year, what's the Dow's going to be? I don't know. And nobody knows. But I don't really care because my whole goal is I want to trade the market without expectations. I don't want to care which way the market goes. Okay, let's go to the next one. Now, this is the jack 'em up and glaze 'em over chart. This is a real chart. These are real trades. These indicators here that you see, these little squares and straight lines and diagonals and diamonds and stuff, those are our indicators. And if you go to the website, you will see those indicators. We also have those indicators on TradeStation, and with TradeStation 2000, you can project into the future. The older TradeStations, you cannot. With Metastock, you cannot project into the future yet. They tell us that they're going to fix it so that you can. And in CQG, you can, definitely. And you can get an anticipation of what the market's going to do, whether it's going to open from the upside or open from the downside. Now, on this one, this BWAO here, this is a CQG chart, and this stands for Bill Williams AO, and we call the AO the awesome oscillator because it really is. And we tell people oftentimes that if you really understand this, if you don't understand anything other than the awesome oscillator, in the next few years, it's our opinion this should be worth 7 figures to you, easily. Because what happens is that the price is the effect of everything. Price doesn't cause anything. It's the effect of everything. What changes before price is momentum. What changes before momentum is the speeding up or the slowing down of the momentum. What changes before the acceleration, deceleration is volume. What changes before volume is all of our crazy decisions. So what we want to do is trade the causes rather than trade the effects. The same thing is true with the Elliott wave. We count the Elliott wave with this. Now, we were training a young trader, very young trader, and we were telling him about the momentum and the importance of it. And he says, Bill, gee, you know, if you're right, man, why don't we just trade that mother? And I said, what do you mean? He says, well, if what you're saying is that this turns green before the price goes up and this turns green before that, this will give you an anticipation of 1 to 5 bars before the price. This will give you an anticipation of 1 to 5 bars before the momentum. So if you're trading a daily, the market will oftentimes give you a week to 2 weeks advance notice of exactly what it's going to, the direction it's going to do. Not exactly what it's going to do, but the direction, which is what we want to know. That's the most important thing. So he said, well, why don't you, when this turns from red to green, why don't you just buy, and when it turns from green to red, sell, and red to green, buy? And we thought, gee, that's an interesting concept. We've been working with this for years, and we've never seen that simple thing. So we tried it out on some experimental accounts. And all you do is if this is a daily, when it turns green the first day, you just call the broker, say buy at the market. When it turns red, you call the broker, say sell at the market. And it produces income. It's profitable. It does not maximize your trading ability, but it gives you a one leg up on the other traders that you know, because you can tell them, look, I will guarantee you that I can make money in the market, and I don't even have to know what the price is or even see a price chart. I just call the broker and say, buy at the market, sell at the market, you know, and they're going to think you're a genius. You really can do this. Look what would have happened here. Where would you have been here? You'd been short all the way down there, wouldn't you? Okay, and on this day, you buy, right? And you get up there, on this day you sell, right? You don't make any money there, but look, you buy there, you sell that day, you buy back, you sell, you buy, and it keeps you in the market on the right side. It doesn't matter whether you're talking about 1 minute S&P or monthly bonds.
Is this what we can see on the website?
Yes, the question is this what you see on the website? This is exactly what you see, and also on the web.
In color.
In color, yes. We had a very embarrassing situation about 2 years ago. Our tutorials are 4 days, and on the last day, the Monday through Thursday, and we do a lot of trading during the tutorial, and on the last day we were having a problem with one guy. I mean, it was just, he was getting the concepts, but he couldn't, we'd say, well, what are you going to do here? And he'd say, well, remember, you do this, you know. And then on the last day, to our great embarrassment, we found out he was red-green colorblind. Yeah, because we were saying, look, man, all you got to do when it turns red, you do this. You know, you just follow the market. And so now we usually ask, is anybody red-green colorblind? And we say, well, what do you do at the stoplight? And he says, well, most of the time the red light's on the top. And I said, well, what about those intersections where they're all the way across? And he says, those I just watch the other cars. You know, so, you know. But anyway, we changed the chart to, I believe it was magenta and brown or something he could tell the difference with. Yeah, I had a question here. Somebody had their hand up. Yes, sir.
Yes, I just want to make sure I understood what you said before about momentum. You said that momentum leads price.
Yes.
And the speed of momentum is leading, and that's right, that's right.
Okay, good. The question is about momentum. The question was, does momentum lead price? Always.
Right.
Always.
The speed of momentum.
Okay, then the second question is the speed of momentum, and this is the speed of the momentum here. If this is green on the AC, and AC stands for acceleration, if it's green, it means that at this point here, where the momentum is down, but it's green, it means the momentum is slowing up. The downward momentum is slowing up, so that gives you an advance warning. If you're in a car and you're approaching a traffic light and you've got forward momentum, you put the brakes on. From a physics standpoint, you're slowing down your forward momentum. But from a physics standpoint, you're accelerating this way. So while the momentum is going down here at that point, it's really accelerating the other way. So this gives you even greater indication of something is about to happen. And then you go to the grounded assessments. Now, the grounded assessments are 5. We call them grounded assessments. This is what gets us in the market. We work a lot. Question, yes? If momentum precedes price, does momentum equate to volume? Yes, in a rough way it does. And what you will see, if we had a volume chart up here, the next time you get your equipment, look at a volume chart. And one of the things you'll see is a mountain of volume stops the market. Now, one of the things that many professional traders don't really understand is what causes a market to quit, what causes a market to top or bottom. And most people think, well, the market goes up here and a bunch of sellers go down, come in. That's not true. What happens is the market runs out of buyers. And the market is an auction market. So if we have a pen here, and all of you are writers, and you've got to write an essay, and you're going to get $1,000, and I've got for the best essay, and I've got the only pen, and I say, who's going to give me $1 for a pen? Everybody will, right? Who's going to give me $20, $40, $100? Who's going to give me $500 for this pen? Well, if nobody does, what happens? I bring the price down, don't I? And that's exactly what happens in any market, stock or commodity. So there is a close correlation between the volume and the momentum. Now, because a market has more volume does not mean that the market's going to go that way faster. Because what happens is it's the psychology of the people. For example, when Greenspan I guess it was about 3 years ago now, when he upped the interest rate a quarter of a point, 25 points 3 times in 3 months. Remember that? A couple of 3 years ago. One time the bonds were up limit, one time the bonds were down limit, one time they didn't do anything. So you've got the same input, supposedly, but the market reaction. And in the Trading Chaos book, our first book, there's a indicator we use, which is the MFI, which is a Market Facilitation Index, which is very simple. It's just the range divided by the volume. And it gives us what we call opportunity windows, fade, fakes, greens, and reds, and squats, I'm sorry. But the important point is that this is the underlying structure of the market. And remember, one of the principles of chaos is that underlying structure can be determined, and you can understand. So this is the underlying structure of this, which is why we put it under there. This is the underlying structure of that. And if we wanted to go further, we would put volume under here. So at every peak here, at here and here, you would see a little mountain of volume. Any other questions? Yes, sir, back on the back. Yes, the question is the AC a derivative of the AO? Actually, what this is it's a MACD oscillator. And an MACD is an oscillator and a moving average of that oscillator. So what the AC is simply the last 5 averages, simple averages, of the AO subtracted from the current value of the AO. The AO is the 5-bar, I'm sorry, it's a 34-bar moving average that is subtracted from a 5-bar moving average. So if the current price starts going up, then that momentum is going to go up faster than that 34-bar. It is an absolutely, in 40-some-odd years of trading, it's the most accurate, profitable indicator I've ever seen. We use it for everything. We use it for options, spreads, trading, everything. Elliott wave counting. This for us is our key. Exactly. Mm-hmm.
And then you take an MACD on that.
No. Then you take a moving average of that, creates an MACD. We just subtract it from that. And again, if you go to our website and download Investor's Dream, you can go through Investor's Dream 1 bar at a time on a kind of a training thing. And what Investor's Dream will do is it will tell you all the buys and all the sells, and the sells that are not valid or the buys that aren't valid, it will have them in there, but it will grade them out. And it even has a button you can push that gives you the broker's instruction so that you can fax that to the broker. And it tells you exactly what to tell the broker on any chart or stock. So if this stimulates any interest at all, I strongly suggest that you go to Investor's Dream on our website. Other questions? Yes?
Work with Metastock or eSignal?
Does this work with Metastock or eSignal? It does work with Metastock, and we have our indicators on Metastock. In fact, Metastock has put us in as their expert advisors, and you can even see a little visual thing that we talk about the alligator. So if you tapped on this bar, you could bring it up, and Justine would be saying, this is below the alligator, you don't want to take any buys, you only want to take sells, that sort of thing. Now that's in their new version, which I think is 7.5, 7.0?
No, the new version that was released a couple weeks ago.
Yeah. How much time do we have?
15 minutes.
Oh, okay. 15, good. Okay. Would you tell me when we have about 5? Mm-hmm. Okay, here's the cocoa. Now, if you're trading in commodities, what you probably already know is the biggest crooks in this business are in New York. So you're going to get the worst deals in cocoa, crude, coffee, sugar, that kind of thing. They have to pay more for their seats up there because they can steal more. Really. I like cocoa. You're going to get bad fills on cocoa, but cocoa tends to trend, and it just keeps on trending and trending and trending. And one of the characteristics of the market is whenever you see a trend like this, notice that the prices are going pretty parallel with the alligator's mouth, right? And the market we're talking about momentum. If the price breaks away from the alligator's mouth, and we'll show you that in a moment, then it has to rest. So it's like the price is just kind of jogging down. If it takes off real fast down, then it goes on a sprint, and then you have to give that money back. The price will retrace. And Justine calls this a gift, and she never likes to refuse, to be so impolite to refuse a gift from the market, which means money. On this particular thing, another factor, another indicator that the momentum has is what we call divergence. And notice the D line and the C line. We have the market here. The momentum is maximum here, isn't it, on the downside? The price is lower here, but the momentum is not as low. And that's a divergence. And you always, always, always have divergence before the end of a trend. You usually have a double divergence. This is a single divergence because you have a price and a lower price and a momentum and a higher momentum. If you had another lower price with a higher, less momentum, you would have a double. Most markets won't go past a double momentum, a double divergence. Every now and then you will see a quadruple divergence. You'll only see a quadruple divergence maybe 3 times a year in looking at thousands of charts. So this gives you a warning from the momentum that something's about to go the other way. Question on the back. Yes, sir. No, it is. The question is that the same as the double bottom? No, it isn't. It's a divergence. A double bottom would be coming back over here, and at this point you do have, I believe, a lower low and a lower here. So you do have a double divergence there. Now, in Elliott wave counting, we had a question a while ago about the time span. The secret to counting the Elliott wave, and let me say in all due modesty, I don't think there's anybody in the world who can count the Elliott wave better than we can. But we don't count it on the price chart. We count it on the momentum. And the key to counting the Elliott wave is to have 100 to 140 bars in the wave that you're analyzing. Not what's on the screen, but in the wave that you're analyzing. Now on this one, we have about 140 bars on the screen. So what this is telling us very definitely is that this is the third wave of the third wave. This is the fifth wave of the third wave. It is not a fifth wave of a fifth wave. And we're in a 4 there, and when this crosses 0, that indicates that the minimum requirements for wave 4 have been met. Now you can start looking for indicators for wave 5 down. And this is on the website too. There's some explanation. There's a guided tour on the website. So if you go to the website, you may want to go through that guided tour. Any questions about this chart? Okay. No, one other thing. We have 5 grounded assessments. The first one is the fractal. And the fractal is a breakout trade. So you've got the world's worst trade location, don't you? Because you're buying the high or selling the low. So you need some confirmation pretty quick, or you need to reevaluate. We also have an indicator that we take on the AO. We have an indicator we take on the AC. We have what we call a reverse fractal or reactive fractal, which we call a balance line trade. And then we have a zone trade. It's like getting in the zone with athletics. So on these charts, on the price charts, you see the red and green bars. Those are the zones. So if you're in a red zone and you're going short, you want to add very aggressively on those red bars. Or if you're in a green zone above the alligator's mouth and you're in the green zone, you want to add buy very aggressively. Yes, sir? Okay, the balance line is very simple. It's where the price would be if there was no new incoming information in the market.
So how do you calculate it? That's what I don't understand.
Okay, the calculation for the balance line is a 13-bar smooth moving average. So you take the 13 last bars, and you add all of those up, and you subtract the average of the most recent 13 bars, and then you project that 8 bars into the future, no matter what time frame it is, whether it's minutes or days or whatever. And then that puts today, where the blue bar is today, or the blue line today, is where the market would be. So what you're getting is where the market would be, and you're evaluating the new information. Now, what you got to realize is nobody knows what that new information is. I mean, if you read the Wall Street Journal or you listen to television and you know what CNBC FNN stands for, can never be correct, Financial Neurotic Network. Really. And for example, we, in our clients, we very strongly recommend you don't read the Wall Street Journal, you don't watch FNN, you don't take newsletters, you don't do any of that. All we ever look at is this screen right here. I don't ever bother with when announcements are coming out or anything. And in the last 12 years, we have had one limit move against us. Every other limit move we've been in on the right direction. So you've got to remember that those guys get paid by the word. They do not get paid for telling the truth, because they don't know the truth, and you and I don't know the truth either. The market goes up because there was more buying than selling. And our definition of the market is that the price is where it is because that's where it's supposed to be, and it's supposed to be there because that's where it is, and everything else is BS. It's that simple. Remember, there's a lot less here than meets the eye. And the process, the psychological conundrum of this thing, the process of learning to trade better is a process of letting go. It's not a process of learning more. It's a process of, there's a discipline called general semantics, and their theme is we're not interested in knowing more and more of what's so. We're interested in believing less and less of what's not so. And that's kind of where we are in trading. Okay, another one. This is Microsoft in 98 and 99. Very easy trade, very profitable trade. This told us that was the third wave. This is the fifth wave. Has 140 bars in there, a perfect 5-wave sequence. And we were long in 1, we were long in 3, and we were long in 5, and we were out in 2 and 4. Okay, we're coming pretty close to the end. And this is Yahoo on a 5-minute basis. Another one, and you can see that we have the saddle point there, and the saddle point, once again, has 3 characteristics. You're in the gator's mouth, the AO is close to 0, the AC is close to 0, and when you see a saddle point, that's when we get excited. Because at the very time that the market is the most boring and not going anywhere, that's where you need to be the sharpest. So this is not the time to go out and get a cup of coffee or something else. This is the time to make plans. And you can see that the fractal was hit just at A, which is coming down, more fractals, more fractals, more fractals, and this is from about, this is one day, but a very, very good day even in the stocks. And again, it works on everything. So what we'll do is we'll take some questions because we have a very, very close connection. We've got to get our panties out of here real quick. But our closing wish is that may everything that you wish for be the least that you get. Questions?
For stock traders, do you have a screening or filtering mechanism for which stocks to purchase?
Okay, the question is, on stock trading, do you have a filter or scanner for what stocks to trade? We trade what's interesting. For example, Ellen trades stocks, and when she read about Viagra, she bought Pfizer, of course, and this kind of thing. They just come. They come more than we can know. There are some scanning functions, but there's always plenty. We look for a saddle point in anything.
And we also, our program is working on doing some of that right now, trying to program some saddle points and things like that. Other things about stocks that's important, you need to trade the things that you're interested in. Where do you spend your money? Where's your money going? Pick some sectors, be diversified. Do not just trade one sector. You will find that you will be very unhappy when that sector crashes.
Yeah.
You want to narrow down to maybe only buying, not selling. You may narrow down the different sectors. So there's ways to do it with 9,000 stocks. It's hard, but we will assist you best we can.
And if you have any questions, call us. We'd be happy to talk with you, help you any way you can. Yes, one more question. Great, congratulations. There's a lot you don't have to unlearn.
Allie has our course, actually. Yes, I have it. I haven't tracked it.
You had to finish her master's.
Upgrade.
Oh.
What is not a great deal of capital?
What is not? We've had people who started off at 5,000.
I suggest you really need 10 to be able to.
Absolutely.
Otherwise, you're limited to what you can trade. You can't hold a contract overnight. You can't add on. So in the beginning, that's fine. You're doing one contract. But if you're looking to do this as a profession to pay your life for your lifestyle, 10,000 is really not
enough.
Say you're going to start a business and you want that business to produce $100,000 a year. You're going to need more than 5,000, 10,000 to start it out normally.
Even with Mary Kay, yes. your chances of blowing out are much less the more money you have. Thank you very much for the honor of you being here. I appreciate it. Thank you.